Welcome to another episode of Equity Mates here on a Tuesday afternoon. My name is Bryce, and as always, I'm joined by my equity buddy, Ren. How's it going?
I'm very good, Bryce. Great to be with you again.
Yes.
As we spoke about yesterday, we're doing a week of interviews with experts from around Australia, talking about how they invest and how they're seeing what's going on in markets at the moment. So excited for this one.
Very excited for this one. It's a topic that we haven't really spoken a lot about on the show, and I think that theme will carry through this week. Equity Mates is all about providing as much perspective and different strategies to the audience as possible, and that's what we're going to do today. And it is our pleasure to welcome Jason McIntosh to Equity Mates. Jason is the founder of motiontrader.com.au and has spent decades building algorithms to help trade the ASX. And we're going to be speaking about all things momentum trading. So, Jason, welcome to Equity Mates.
Hey, Bryce, it's good to be on. I think it should be a good chat about all things momentum.
Looking forward to it. As I said, momentum is a strategy that Ren and I are certainly aware of, and I think I may have tried to dabble in it a little bit more than Ren has, but really interested to pick your brains on it today. So I know that for a lot of the community, it will be a new concept. So let's start at the top. For those who haven't come across momentum trading before, are you able to explain it for a beginner?
Yeah, look, I think probably the simplest way to start explaining it, it's basically all about going with the flow. So it's about identifying the current direction of the market and then investing with the trend. It's pretty much the underlying philosophy is as simple as that. So it's about works on the basis that the trend is it's really the path of least resistance. And so that means that, like, if a stock's been rising over the recent period, odds favour that it's going to continue rising over the next period. And so momentum exists across all sorts of time frames. It can work on a very short-term basis or a long-term basis. So like a day trader, for instance, might be looking at a chart that's generated every 15 minutes or every hour. Or someone taking a really long-term focus might be looking at a weekly chart or even a monthly chart if they've got enough data. So, for example, I'm looking for medium-term momentum or medium-term trends. And for me, medium-term is really, say, 9 months through to maybe 2 years. So what I want to identify stocks that could rise significantly over that period. And I find that over 1 to 2 years, some stocks which really got good momentum behind them, they can rise around, could be like big double digit or even 100% or more. So you can get that sort of gain over that time period. And look, I don't want to be looking at the screen all day. So that's why I'm in that medium term area. I've done the short-term trading, like I've been on trading desks where I'm looking at charts and momentum all the time. But nowadays I'm using that end of day sort of data to look for those medium-term trends. And now the thing which is important to understand with momentum trading, or pretty much any sort of investing for that matter, is that momentum doesn't guarantee success. And it's like you can buy a stock and it can lose momentum the next day. But the thing to really understand is that what all the best stocks have in common is that they've got strong momentum. So momentum doesn't guarantee you're going to get on a superstar stock, but it puts you in the path of all the best stocks because all the best stocks have momentum. And the other thing it does, it helps keep you away from stocks which are underperforming. So if you look at the list of underperformers for the last financial year, anyone following a momentum strategy, you can be pretty much assured they're not going to have those stocks in their portfolio, because like you look at a stock like AMP or like A2 Milk last year. A2 Milk was a standout, say a couple of years ago, but then over the last year it's lost about 90% of its value. So someone using a momentum strategy would have had a process to exit A2 Milk, or if they were then looking at the market now, they'd be saying, well, or over the last year, they'd be saying, well, look, we'll stand back. We won't look at this stock for the time being because the momentum or the trend is down. So it's a very useful strategy for identifying what to get into and what to give a miss.
Yeah, nice.
Yeah, it is. It's a fascinating way of looking at the market, Jason, and conceptually it makes a lot of sense. You know, those. I guess it ties in with letting your winners run, and good stocks and quality stocks continue to show momentum over the long term. I guess more specifically, what are some of those indicators that you're looking for as a momentum investor that indicates this stock has good momentum and might be a good buy?
Yeah, so look, the key for me is to keep the process simple and keep it consistent. So it's so easy in investing to overcomplicate things, to overcomplicate an approach. And the more complex an approach gets, the more likely it is to sort of fail over time. And I see like a lot of traders and investors have got an array of indicators and all these financial metrics that they look at, but it's difficult to make these complex approaches work over time because conditions change, and the more complex an approach is, the less adaptable it is to the changing market environment. That's not to say that the approaches I use work in every part of the cycle, but they've got a long history of working over market cycles, like over time. And so look, two of the key indicators that I use. Firstly, I use an indicator called a moving average. So just for people who don't know what a moving average is, to break it down simply, it's a really basic trend following indicator. So say like I use one of the moving averages I use is a 50-day moving average. So what that does, it takes the average price of a stock over the last 50 days, and you get an average. And then tomorrow, it's going to drop off the 50th day, and it's going to bring in the new day, and that will be the 50-day moving average for the next day, and then so on. So you get this average price. And what the moving average is really good at doing, it really helps gives you a visual on the trend. So when you look at a chart, there's a lot of movement in the day-to-day price. It's up, it's down, it's sideways, but you put a moving average on and it really does help to smooth it out, so it becomes easy to see that trend. So what I do, I combine two moving averages. I'm using a 50-day and a 100-day moving average. And so what I want to do, I want to buy when the moving averages are pointing up and the 50-day moving average is rising above the 100-day average. Just means that the trend is, shows you the trend's up. So that's the first one. That's sort of like, you could think of that like as a rudder on a boat. It's giving me the broad direction of where I'm going. And then another indicator I use is called it's called a breakout strategy, or what it is for me is I'm using a 70-day high as a trigger point for getting into stocks. So whilst the moving averages are great at giving me the broad trend, the stock hitting a 70-day high, and for that matter, it could be a 50-day or a 60-day. 70 is no magic number. It just works well for my medium-term time frame. That tells me that the trend as of today is very much up. Now, some people will hear that and go, well, that's a bit of a funny thing to do. Why would you want to buy a stock after it's been rising for 70 days or it's at a 70-day high? And because they hear these maxims like, you buy low, you sell high. And they think you want to buy a stock maybe at a 70-day low would be a better idea than a 70-day high. But this is the thing with a trend. The trend is a path of least resistance. So it often works out better to buy a stock that's been rising and letting that momentum continue on. So I find they're both good mechanisms for identifying stocks and then getting the timing to get into the stock.
Nice, Jason. So I guess the follow-on question from that is then the sell side. So you can recognize when to get into the stock, but is it as straightforward, I guess, as to understand when is a good time to get out?
Yeah, it's a great question. It's like, I think selling, it's one of the, look, I think for many people, selling is really a bit of an afterthought. It's like so many people want to tell you, when to buy. That you can read it in the newspapers, read it in the, you watch the TV, you subscribe to a service. Lots of information on, talk to your mate at the pub. There's lots of information on what to buy, but the, when to sell is, it's a really important part of the equation, which a lot of people don't really have a firm grip on. And I think that like selling, it really is quite an emotional part of the investment process for a lot of people, because it's when you sell that you make your money or you lose your money. And when emotion gets involved with the process, it's really easy to make mistakes. So a common mistake would be you've got a stock, you made a big gain in it, say you're up 100%. The stock starts to fall back. You haven't really thought about when you should sell, and you go, oh, well, look, it's come back 20% now. I don't want to sell now. And then next thing you know, it's down 50% from its high. You're still in the money, but you're giving a lot back. The emotions kick in. You don't have a strategy to sell. So many times I've heard these stories of people riding these great stocks all the way up and then all the way back down and then into a loss. And the other emotional time is when you buy a stock and it just it starts to fall pretty much straight away, and people don't. Taking a loss is really hard for a lot of people. We hear the studies about how it's more painful to take a loss than take a profit. So you might see your stock fall 10%, 15%. You go, oh look, I hope it comes back. I think it'll come back. You stay in a bit longer. Next thing you know, you got an A2 milk which is down 90% from where you bought it. What do you do now? It's a disaster. So it's that's why selling's so important. You've got to have a plan. So what I do, I'll use what's called a stop loss. So whenever I buy a stock, I'll always have a stop loss in mind. So a stop loss is a predetermined selling point. So you really want to make it as clinical, as unemotional as you can. So it's not about when a stock's falling, you're sort of on the run thinking, what should I do? It's about you've got this predefined plan. You know where you're getting out when you get in. And now there's two parts to the selling. You've got to work out when you're going to sell a losing stock, but then a lot of stocks will run. They'll start going up in value. You've got to work out, you've got to have another plan when you're going to sell a winning stock. And I think the key to making a lot of money in stocks is you've got to let your winners run. And this is a hard part for a lot of people, because you often hear of people, they get say over a couple of months, a stock's up 20%. And you go, well, look, bank's not paying me much money. I'm up 20% in 2 months. I don't want to give that back. So maybe I should take a profit. Problem is, if you're taking 20% profits, if you're taking modest gains, how do you ever get 100% gain? How do you get those big wins? And the answer is, well, you can't. You can't get big wins if you're taking small wins. So this is part of the selling strategy, is to let your profits run until a point where the momentum of a stock starts to roll over, stock starts to move downwards. You've got to give them room to move, so you can't get out straight away. You've got to give it, the market needs to, zigzags its way to the top. So you want to try and stay in on the zags, but it will get to a point where you say, okay, I've given enough room to move. Now's the time to exit. And of course, all that's pre-calculated, it's predetermined, so it's not you're getting emotional and you're trying to think it on the run. So yeah, that's the key for this selling point. Have that predefined strategy, a trailing stop loss for your winners, and just a clear-cut exit stop loss for your new positions if they're not working out. Don't be afraid to say, hey, this one's not working. I'm out of here. I'm going to take my capital and put into a new opportunity rather than hope a stock that's not working out comes back.
Yeah, I think that point there, Jason, around how much, airtime is given to stocks to buy compared to the right time to sell is a point well made. Everyone is always looking for the next buy, and perhaps they should be thinking more about managing their portfolio. Now, we are almost out of time, and luckily we do have you back tomorrow to talk about what you're seeing at the moment in the market and 3 stocks on your watch list. But just quickly before we wrap up, we've been talking about momentum in the context of stocks and the ASX. But there's a lot of people in the Equity Mates community that are loving crypto or are interested in crypto. Do a lot of these principles that we're talking about with momentum investing carry over to other markets like the crypto market?
Yeah, absolutely. It's basically a trading approach. It's a process, and the underlying principles are transferable to pretty much any market. So I've been using these principles since I started in financial markets back in, I think it was 1991, where I first started learning about this. So I've applied them to commodity markets, currency markets, interest rate markets, equity indexes. Same principles. It's about buying as prices are rising, so buying with the trend, letting profits run, giving your profits room to move, cutting losses, spreading risk. They're just universal principles, and they work really well in cryptos as well. So particularly over the last couple of years, we've had a lot of momentum in the crypto space, both on the upside and the downside. So it's quite possible to make a lot of money in these cryptos, which are moving a long way quickly with a basic trend following strategy where you're buying with the momentum, not trying to buy the dip. Like when the momentum falls and you see the crypto coming back, a lot of newcomers go, oh well, look, it's 10% lower today. This is cheap. I better buy some. Problem is the momentum may have shifted to the downside, so you end up the next day it's 20% cheaper. So it's about buying with the trend, not trying to preempt where it may go, letting it run. And when that trend does change, you have those exit strategies to get out. And so you could have participated in that Bitcoin rally we saw earlier in the year, taken profit before it had that big downturn that we've seen over the last few months. And with the say Bitcoin turning up again over the last month, maybe it's opening the potential for another upside momentum trade. So yeah, very, very, very transferable across the markets, and I think works very well in that crypto space.
Nice, Jason. Well, we're going to have to leave it there. We do appreciate your time. But the good news is you're back tomorrow with Watchlist Wednesday to share some stocks that are appearing up on your screens, and also to close out some conversation around what you're currently seeing in the market. So very much looking forward to that, and we appreciate your time.
Fantastic. Now, look forward to coming back, guys. Thanks for having me on.
See you tomorrow. That brings us to the end of today's episode. Hopefully you were able to get something from that will help your investing journey. You can follow what we're doing at equitymates.com, but otherwise we've got Jason back tomorrow.
Yeah, can't wait.